Fabulous. Hi, everyone. This is Kathy Lien, and I'd like to thank all of you for joining me today in our non-farm payrolls preview. Basically, non-farm payrolls is the most important event risk for us as FX traders. And so what I would like to do is I would basically like to talk a little bit about what we expect for non-farm payrolls. I know that some of you may have joined us for our live trading non-farm payrolls webinar last month. We're not doing it again this month except for our members, but I'm just looking at Mauricio's comments. But in general, it's something that's, it's very high profile. And hopefully I'll give you a little bit of insight into what we are thinking. With that, I think the first order of business to share with you my computer screen. And, generally speaking, I like to start with looking at price action. So, I've got a lot of indicators in my charts, and actually I'm watching the Dow right now, but you can see today the US dollar is down pretty much across the board. It's flat against the Japanese yen, but, it's down compared to where it was trading much earlier during the trading day. So this tells us investors are selling dollars ahead of non-farm payrolls, and perhaps they have good reasons, and we'll take a look at why they may be doing so, and what it potentially means for us as traders. Now, I'm going to leave the questions to the very end because I actually have it open this computer because I was chatted to me on this computer. So if you've got questions, please feel free to type away, and don't hesitate if I ignore them for now, because I'll get back to them after I go through the topics that I want to cover. So, not only has the US dollar performed well today, but if you take a look at this graphic I have here, showing you, I'm just going to maximize it. Let me just double check that no one's saying that they can't see what I see. Okay, fabulous. All right. So this shows you how the US dollar has performed throughout this week. And for the most part, the US dollar is down across the board. The only currency that's not down against is the Japanese yen, but, it's kind of getting there. So US dollar is down across the board, and it's been definitely a challenging week for the greenback. And what's really interesting about this move is a couple of things. First and foremost, if you take a look at this image that I was looking at earlier, which basically is the 10-year US yield spread, and the 10-year US yield spread's up about 10 basis points. Is up 10 basis points since the beginning of this week or the end of last week. So yields are up, which should be good for the dollar. Also, if you take a look at this dollar yen chart here, you'll see that yields, which is the orange line, this is the 2-year US minus 2-year Japanese JGB yields. They're pointing lower, but they run away quite a bit. And dollar yen there's a huge divergence. And I think there needs to be a correction. I think the correction could very well come in the form of US dollar yen strength. But should you be buying US dollars ahead of non-farm payrolls? Well, to answer that question, every single month, we look at a number of leading indicators for non-farm payrolls to give us a sense of how the labor market could fare. Now, the most important non-farm payrolls leading indicator is the ISM non-manufacturing index. And actually, the other thing I want to mention is that the other thing that's particularly interesting about this week's US dollar weakness is that if we flip our calendar to the 29th, which was this week, hopefully this will update. Not sure why it's not. Because 29th is not a valid day. What you will see is that for the most part, with the exception of today's reports, we had better data. ADP was stronger, ISM manufacturing was stronger, kind of mixed to slightly better. But today we had the U.S. non-manufacturing ISM index, which actually beat expectations. Durable goods firm. But the problem is that it wasn't good enough. But what really is alarming for people who want to be long dollars going into non-farm payrolls is that this little line item here that says the ISM U.S. Services Employment Index dropped to a 2-year low. So the employment component of service sector ISM dropped to a 2-year low. This is a pretty big deal because this indicates that, the service sector saw weaker job growth. And in fact, it saw a contraction in jobs. The index was 49.7 versus 52.1. And I actually want to go back and see when was the last time we actually had this in, there actually may be a little headline here. It falls to the lowest level since July 2009. And let's see if we can get a little graphic here. So this is actually the first contraction. I mean, that can't be accurate because February 28th, 2014, we have 47.7. But either way, this is the first contraction that we've gotten in 2 years. And so let's see how non-farm payrolls fared that month to see if we can get any type of insight. So February 2014, we did have a drop in non-farm payrolls. Obviously, it wasn't as significant of a drop as the contraction warranted. It was only from 187 to 168, but still, it represented a drop. And I want to go back to that ISM number again, because I want to take a look at something else that I want to share with you. We take a look at the employment component. It was a very steep drop. So the magnitude is much more significant than we had right now. But nonetheless, it does represent a slowdown. We also had a drop. We've been seeing consistent drop for 2 months in a row. And with the last non-farm payrolls report, if you'll remember, that was, in February, non-farm payrolls actually fell significantly. So the market looked at this as a positive number simply because the unemployment rate improved and average hourly earnings increased. But non-farm payrolls, the headline number itself was quite ugly. So why am I showing this and why am I telling you this is important? Because the reason why I'm telling you that this is important is because just for between December and February, we already had a very steep decline in payrolls from 262,000 to 151,000. So while the ISM non-manufacturing index points to weaker job growth, and I think that that's still the greater likelihood. You have to realize that we already had a big miss, and so if we have an even softer number this time around, that would obviously be a very, very ugly release. So there's scope that perhaps the data is wrong, but what it does tell us is that even if we do get a bounce, it's not going to be 195,000. It may be 170,000, for example. Other things that we look at as leading indicators for non-farm payrolls includes the manufacturing employment subcomponent. So the manufacturing employment subcomponent actually increased from 45.9 to 48.5. So on the one hand, you have the ISM services data arguing for weaker payrolls, and on the other, you have the manufacturing data arguing for stronger payrolls. But what else do we have? Today, we also had jobless claims come out and continuing claims. And if you look at the historical statistic, and you see that I already read this article because I was looking at it this morning when it came out, the 4-week moving average basically dropped from 284,000 to 270,000. So this is an improvement and definitely signals stronger payrolls. So far, we have 2 indicators that signal stronger payrolls. Unfortunately, we also see that the continuing claims went from 260, which would have been the last number that we got, to 257, which also showed a little bit of improvement. But the issue here is that we all know that jobless claims is very low, and Fewer job losses have not translated into stronger job growth. And so you have to take this, you take that into consideration, and maybe discounts the importance of this a little bit, because overall we still remain below 300,000. Anything below there is still consistent with a good number. We had the ADP number. We had challenger job cuts released this morning that saw fewer job cuts, which is good news. Yesterday we had the ADP employment change, which also saw an improvement, which is good news. So far we have 4 items pointing to stronger payrolls and 1 pointing to weaker payrolls. Another index that we look at is sentiment, and the University of Michigan Consumer Sentiment Index basically dropped from 92 to 91.7, so sentiment deteriorated, which suggests that maybe the labor market weakened. The other number that we look at is consumer confidence. And let's take a look at the consumer confidence index. Maybe if I sort it, I'll find it faster. Okay. So the consumer confidence index from the Conference Board actually nosedived in the month of February. This was the lowest confidence reading that we've seen since November 2014. And so how does the tally come up now? Let me just write down lowest since. So basically the way things stand is we have 8 leading indicators that we look for non-farm payrolls, 5 of which signaled to us that job growth could be stronger, and 3 of which point to job growth potentially being weaker, with 1 of those 3 being the employment component of ISM services being a little bit uncertain, simply because there was such a huge drop already in the headline non-farm payrolls number. So the only thing that really tells us is perhaps there's a downside surprise that may not get to 195,000, but we could see 160, 170, for example, in the change in non-farm payrolls. So where does that leave us? Well, of course, you all know that when it comes to non-farm payrolls, there's a couple of things that we pay attention to. We pay attention to the change in non-farm payrolls. We also pay a lot of attention to the unemployment rate and average hourly earnings. Both the unemployment rate and average hourly earnings improved significantly in January, so maybe we have some payback in February. Average hourly earnings is already forecasted to have a bit of payback. The unemployment rate is expected to remain unchanged, but it could increase a little. So taking a look at all this, I still think that non-farm payrolls is going to miss expectations, and that there's going to be a greater risk of a downside than an upside surprise in the non-farm payrolls report tomorrow. So what does that mean? How can you position for that? Well, trading non-farm payrolls is always very, very difficult, because we did have that really ugly reading in the headline non-farm payrolls release in January, but there's scope for scope for revisions. We know that non-farm payrolls is oftentimes revised, and we could have an upward revision that could offset any downside surprise. So that's obviously important as well, and also something that we watch quite closely. So all of that is things to pay attention to, keep in mind, and it still nonetheless has us thinking that non-farm payrolls could be weaker and not stronger. So what does that mean in terms of positioning? Well, one possibility is to look to sell dollars against a currency pair that's strong already. Aussie's had a very nice run. I think it's gotten a little overhead itself. Kiwi is just beginning to potentially break out. That's a currency pair to watch. But I think, between and then, of course, there's dollar Swiss, which is breaking down. Between these 3 pairs, I think that maybe dollar Swiss, if you're looking to sell dollars, maybe selling dollars through the Swissy is the cleanest bet, because the risk above parity is very clear. And that would also be above some key technical levels. Not only is it a psychologically significant level, but you also have 2 important moving averages hovering right around those points. However, if the data comes out good, and you probably want, I think, to wait until after non-farm payrolls come out, I think the greatest strength that you're going to see the dollar against is the euro. Euro's rallying a lot today. ECB is next week, and that's a huge event risk for the euro itself. And I think that there's definitely there's definitely a correction that could happen off of the a good non-farm payrolls number. But recognize that right now the market is bullish dollars, and given that it's bullish dollars, the market is already anticipating the market is bearish dollars, and given that the market's probably already anticipating a slightly weaker release that may not see as extended gains as maybe an upside surprise. Now, all of this is important because the conversation centers around what does this mean for the FOMC meeting later this month. And in terms of FOMC, I think at this stage, no one really expects the Federal Reserve to raise interest rates. I think their message has been quite clear that they don't really intend to do so. But if labor market data is good, they could say that we maintain a hawkish bias, which is very, very likely. And if they maintain a hawkish bias, you may have a relatively shallow sell-off in the U.S. dollar. So non-farm payrolls this week is very, very important, and it's going to play a very large role in setting expectations and price action for non-farm payrolls. So now I'd like to kind of open up the floor to any questions that you may have. In terms of how I feel about the dollar, Mohit's asking, generally I feel the dollar is weaker a day before NFPs if it needs strengthening, isn't it? It's just because these days the market is expecting the Federal Reserve to do less, and they're kind of skeptical of the labor data. But overall, that's what we have right now, what the current existing thinking in the market is. Any other questions that you may have? So what are some ways that you can trade non-farm payrolls? I talked a little bit about how you can trade non-farm payrolls proactively with maybe, selling dollars if you believe these leading indicators. Or you can trade it reactively, and, perhaps the greatest gains you may see is in the dollar versus the euro. But, it does pay to wait with non-farm payrolls, because let's take a look at the last non-farm payrolls report, for example, which let me just confirm the date of this. Oops, that's the wrong image that I want to pull up. Okay, so the last one I think was February 5th. So let me just kind of zoom out. Let's look at dollar again because that tends to have the purest movement. February 5th, going backwards, almost there. So remember, the headline number wasn't that great, but the details were much stronger. So this is dollar yen. So what happened? Basically, what happened was initially at 8:30 right here, you had a dip in the dollar and a rally. What I think typically is the best thing to do is to wait about 15 minutes after the number comes out. Make sure that the data, that the candle confirms the data, because there's a lot of crazy volatility in the first 15 minutes, and then buy for maybe a short-term scalp of 20 or 30 pips. So, and you may be able to get more, but waiting 15 minutes tends to be a good tactic to use. And just look at the euro, February 5th, and we use that as a rule of thumb for a lot of our news trades as well. So February 5th, same story here. 15 minutes confirm weakness, and you can see you would have sold at 1160, and the low here was 111.07. Even if you got out here, it was a 111.13. So you still would have been able to squeeze 20, 30 pips after that. And that's how I would take the reactive move, which is usually by the first 15 minutes, you have the real reaction that the market's going to have potentially for for the day. Any correlations in dollar to oil? There's a huge correlation between dollar and oil. Oil is priced in dollars. So when the dollar falls, oil rises, and when the dollar rises, oil falls. Should we sell the dollar euro if the number is good? If the number is unambiguously positive, with average hourly earnings beating, with the unemployment rates holding steady, with non-farm payrolls beating expectations, you could sell the dollar against the euro. But why would you want to, given that the forces of the ECB next week? I mean, if it's a short-term play, you could, but I think it would be much smarter either to just go straight out dollar yen or to go one of the other currencies. But of course, euro will probably move the same way anyway, but just be wary of holding it past the weekend. Any other questions? Okay, so hopefully you've got a little insight into how to think about non-farm payrolls for this month. And I hope that I apologize for this being a little short, but I've got to jump on another meeting fairly soon. So if the news is good, sell the dollar. No, if the news is good, you want to buy the dollar. I don't know what you're asking, Tossin. If the news is good, you want to buy the dollar. If news is bad, you want to sell the US dollar. Okay. So as I said, if you have any additional questions, you can always email me at Kathy@bkforex.com. More than happy to answer them. Talk to you later. Bye.